Welcome to Talk Tickers. We're your direct line right into the heart of earnings calls. Today, we're doing a deep dive into South Plains Financial, looking at their second quarter 2025 earnings.
Yep.
Our goal here, as always, is to kind of cut through the static, pull out the really essential insights for you, give you a clear picture of how they performed and where they might be heading strategically.
Exactly. We'll get you the key takeaways, maybe a few surprises along the way. So let's kick off with the headline numbers for Q2. South Plains reported diluted earnings per share of 86 cents.
86 cents. That's a pretty decent jump from the last quarter's 72 cents.
It is, but it's important to note there was a boost in there. About 9 cents per share came from a one-time benefit.
Ah, okay. What was that?
It was a $1.6 million interest recovery. Came from a loan that, had been on non-accrual status.
Non-accrual, meaning they weren't booking interest on it before.
Correct. So getting that cash back is a direct hit to the bottom line this quarter. Nice little bump.
Okay, got it. So let's dig into that a bit. Net interest income, that climbed too, right?
Yeah.
To $42.5 million.
Yep, up from $38.5 million.
Their net interest margin, the NIM, I saw that expanded significantly.
It did. On a tax equivalent basis, it went to 4.07%, up from 3.81%.
Wow. Now, how much of that was from the recovery?
Good question. That recovery added about 17 basis points to the NIM.
Okay, so still,
Yeah.
even if you back that out.
Even backing that out, the underlying NIM still rose by about 9 basis points to 3.90%.
And what's driving that underlying improvement then?
Primarily, it was a drop in their cost of deposits, about 5 basis points lower. So they're managing their funding costs effectively.
Interesting. And how does this connect to, say, loan growth? Did they grow loans much?
It was modest growth. Loans held for investment were up $23.1 million. That's about 3% annualized.
Okay.
Total loans hit $3.1 billion. Importantly, the yield on those loans climbed to 6.99%.
Up from 6.67%.
Yeah.
So better yield on slightly more loans. It seems like they're focusing on profitability there.
Yeah, it suggests maybe higher yielding new loans or just better returns on the existing book, yield over just pure volume, perhaps.
Makes sense. What about the other side? Non-interest income.
That showed strength, too. It came in at $12.2 million.
What drove that?
Mostly mortgage banking revenues they picked up. And also a positive fair value adjustment on their mortgage servicing rates, MSRs, as rates kind of stabilize.
Okay. Now, you mentioned deposits earlier, the cost going down.
Yeah.
But what about the actual balances?
Yeah, that's an interesting point. Total deposits actually decreased this quarter.
Oh. By how much?
Down about $53.6 million, landing at $3.74 billion.
Why did it drop?
They said it was mainly seasonality, public fund deposits moving out, which happens. It's pretty typical.
Right, you see that with municipalities, school districts, things like that.
Exactly. But here's the key thing. Even though total deposits dipped, their non-interest-bearing deposits actually increased.
Really? By how much?
Up by $32.3 million. So that pushed their ratio of non-interest-bearing to total deposits up to 26.7%.
Okay, that's significant. Those are the best kind of deposits, the free ones, signals a stickier, healthier base.
Precisely. It's a low-cost funding advantage.
And wrapping up the snapshot capitalization, how are they looking there?
Very strong. Consolidated Common Equity Tier 1 ratio, 13.86%.
Well above regulatory minimums.
Definitely.
Okay.
And their tangible Common Equity to tangible assets ratio, that's at 9.98%. So plenty of cushion, lots of flexibility.
Okay, solid foundation then. Let's dig deeper into some of the management discussion now, starting with that loan portfolio.
Right. So management talked about being proactive, and that actually led to maybe counterintuitively a higher level of early loan paydowns this quarter.
Higher paydowns, but they still managed some growth.
They did, modest growth, and they said the pipeline still looks healthy. But yeah, those payoffs were a bit of a headwind. They actually expected it, though.
Proactive management causing paydowns. How does that work? Does it hurt their growth plans long term? I saw they mentioned some big multifamily payoffs.
Yeah, 3 big ones totaling almost $50 million. Dallas, Houston, El Paso saw balances decrease, partly because of things like this. It's kind of a double-edged sword, isn't it?
How so?
Well, yes, the accelerated payoffs hit the overall loan growth number, no question. But, and this is important, some of those payoffs were actually problem loans they'd flagged before.
Cleaning up the books.
Exactly. And others were what they called cheap-priced loans, basically. Loans with lower rates or less favorable terms that they weren't necessarily sad to see go off the books.
So it hurts the top-line growth number short-term, but potentially improves the quality and yield of the remaining portfolio.
That seems to be the idea. They do expect payoffs to start moderating a bit in Q3, but, still be something of a headwind.
Okay, that makes sense. Optimizing the portfolio quality. So looking ahead, how are they planning to grow assets? Both loans and maybe overall?
They talked about a dual strategy, really. Organic growth and M&A.
Right.
On the organic side, it's about expanding their lending capabilities, trying to accelerate that loan growth over time and funding it.
Leveraging their community bank deposit franchise.
Okay.
That gives them stable, lower cost funding.
Yeah.
And they're actively trying to grow core deposits while keeping an eye on liquidity, naturally.
And how are they boosting lending capabilities specifically?
A big piece of this, and they highlighted it, is recruiting experienced lenders.
Hiring talent.
Yes, particularly in key markets like Dallas. They're bringing in people with established track records, strong relationships. The goal is clearly to bring new business, both loans and deposits, to the bank.
So investing in people to drive that organic growth.
Definitely. And they were clear, they're not pausing that hiring effort, even if they find an M&A deal. They see it as a long-term play, building out talent.
So it's a both-hand strategy, not either. Grow organically and look for acquisitions.
Precisely.
Speaking of M&A, they mentioned their past deal, West Texas State Bank, back in 2019, and they noted the M&A pace seems to be picking up in the industry.
Yeah, they even mentioned the recent Huntington Veritex deal as a sign things might be thawing a bit. So are they actively looking? What's the hurdle if the environment is improving?
They hope the improving climate makes seller expectations more realistic, but they have pretty strict criteria.
Like what?
The right culture fit, the right asset liability mix, a stable deposit base, and crucially, a sensible valuation.
And finding all that is tough.
Apparently, yes. The biggest hurdle right now, they said, seems to be those seller expectations on price, especially when you factor in AOCI issues.
Okay, AOCI. You hear that term a lot lately. Can you break that down simply? Why is it such a roadblock for bank deals?
Sure. AOCI stands for Accumulated Other Comprehensive Income. Think of it like unrealized gains or losses on certain assets the bank holds, mostly securities like bonds.
Okay.
When interest rates move sharply, like they have, the market value of those bonds can fall, creating big unrealized losses that sit in AOCI on the balance sheet.
And that messes up deal math.
Big time. When a buyer looks at a target bank, these AOCI marks can significantly reduce the reported equity, the book value. It makes agreeing on a fair price much harder because the true economic value gets debated. It clouds the picture.
Got it. So it complicates the valuation significantly. Yeah. Makes sense why they'd be patient then, especially if their organic strategy is working.
Exactly. Why overpay or take on a messy balance sheet if you can grow internally?
Right. Now, besides M&A complexity and loan payoffs, what other sort of external headwinds are they navigating? They mentioned tariffs.
Yeah, they did see some impact there. Their indirect auto loan portfolio saw a bit of a decrease.
Okay.
And they noted consumer spending seemed to slow down a bit in May, potentially because people were anticipating tariffs. They think that might remain a headwind for auto loan production in the near term.
Are they doing anything about that risk?
Yeah, they mentioned they proactively tightened their loan-to-value requirements in the auto segment. And interestingly, their delinquencies, the 30-plus days past due loans in that portfolio, actually improved.
Oh, so they tightened standards, maybe saw a bit less volume, but the quality improved.
Seems that way. Suggests they're managing the risk electively, even with those external pressures.
Good sign. Let's circle back to deposits for a sec. Total down, but non-interest bearing up. What drove that increase specifically?
They pointed to their treasury management solutions really maturing and gaining traction with business clients.
The sticky business deposits.
Right. And also proactive efforts to get deposits from their existing loan customers, deepening relationships.
Makes sense.
They even mentioned their incentive comp plan for lenders rewards both loan and deposit gathering. So it's baked into how they operate.
Get the whole relationship, not just the loan. Okay, and finally, let's just re-emphasize that capital position. TCE ratio near 10%, Tier 1 well above 13%. What does that strength really allow them to do?
Yeah, it's not just a regulatory thing. It's a strategic weapon, really.
How so?
It means they have the financial muscle, the firepower, to actually do an accretive acquisition if the right one comes along at the right price. They can pull the trigger. Or,
and this is key, especially with M&A being tricky, it lets them return capital to shareholders more aggressively. Buybacks, dividends.
Right, flexibility.
Exactly. That strong capital, combined with the organic growth focus, the talent acquisition, managing those payoffs, it positions them pretty well, especially operating in Texas, which remains a resilient economy overall.
Even with things like tariff noise lingering.
Even with that, their ability to manage the portfolio, bring in talent, and handle deposits seems key.
Okay. And that strong capital position, coupled with the M&A challenges, that actually leads us neatly into our next segment. It's time for This Is Not Financial Advice, where we pitch an outrageous but plausible trade idea, kind of like a hedge fund analyst talking to their investment committee.
All right, let's do it. So given everything we've just discussed, South Plains rock-solid capital, right?
Yeah.
CET1 at 13.86%, TCE near 10%.
Yep, very strong.
And management explicitly says they're committed to returning capital dividends, ongoing buybacks.
But acknowledging those real persistent challenges in finding M&A that works right now, the seller expectations, those pesky AOCI issues we talked about.
Okay, setting the stage. So what's the trade idea?
The trade is to anticipate a major step up in their share repurchase program.
More than just the usual buybacks.
Yeah, think bigger. Something non-routine, a really substantial acceleration, maybe even, a large tender offer for shares.
Wow, okay. Why would we do that? What's the signal?
It would be a huge signal of management's confidence in their own organic growth story, especially with all the lenders they're hiring.
Right, betting on themselves.
Exactly, and it signals a powerful commitment to shareholders when good M&A deals are scarce. It says, we can't find a deal we like, so we'll invest heavily in our own stock because we think it's undervalued and a great use of capital.
So deploying that strong capital directly back to shareholders in a big way.
Precisely. Such a decisive move, particularly when acquisitions aren't happening, could really cause the market to re-rate the stock.
How so?
It could position South Plains as like a uniquely shareholder-friendly bank. A cash-generating machine focused on returns, standing out in the regional banking space.
Interesting. An aggressive buyback as a strategic statement. Plausible, definitely potentially provocative.
That's the idea for the segment.
All right, so wrapping up our deep dive then. South Plains Financial delivered a pretty solid second quarter overall. Strong earnings, strong capital.
Yeah, definitely. Proactive management seems key, dealing with payoffs, hiring strategically, keeping an eye on M&A, even if it's tough right now. They seem positioned okay for growth in Texas.
The focus looks like it remains on getting that loan growth engine going faster, maybe pushing that NIM up further, and definitely delivering shareholder value. For you, though, what stands out as the most significant takeaway from their quarter?
Good question. For me, it's probably that combination of actively cleaning up the loan book, letting those cheap loans run off, while simultaneously investing heavily in new lending talent for future organic growth. It shows a clear focus on long-term profitable growth, not just chasing size.
Yeah, playing the long game.
Okay.
Well, thank you for tuning in to Talk Tickers today. We really appreciate you joining us for this deep dive.
We hope you found it insightful. We'll be back soon with another earnings call breakdown. Until then, stay informed.